So Britannic is a Guernsey company that's listed in Bermuda. The shares of the company have existed for the last 5 years, and that investment phase is finishing now in July. And at that stage, a new opportunity arises for new investors to buy shares and existing investors to retain some or all of their shares. So the next phase, which will start in July, it gives exposure to a combination of 40% S&P 500, 30% to the Nikkei 225, and 30% to the Dow Jones Eurostoxx 50. We've selected this combination because it's 97% plus correlated to the MSCI World Developed Market Index. So the product is for high net worth investors who have at least $18,000 to invest and who would like to have a secure investment whereby the downside risk of the market is eliminated, and where they think that the market may not have a massive upside, but they'd like to get a good return for a moderate market. So the potential returns are a function of what the market does, but keeping it simple, if the investor puts in $100, then over the investment term, which in this case will be 3.8 years, if the markets as depicted go down, then the investor will still get $103 back in the share price, and that will then be similar to having put the money at a bank. If though the markets go up, which they normally do and which you would expect and hope that they would do, then the investor will get twice the performance of the indices, from 3% positive through to 18.5% positive. This means that that distance is 15.5, and if you got double that is 31, plus your 103, in other words 134. So if you summarize it, in a time that the market goes down 50, you're getting positive 3, and at a time that the market does 18.5 or anything more, you're getting immediately 134. So you would underperform if the market physically did over the 3.8 years more than 34%, but you're getting the benefit of not having the downside risk. So the risks are basically threefold. Firstly, the security that provides the 103 return is a combination of First Rand and ABSA unsecured subordinate debt, which is we refer to as Tier 2 debt, which would rank behind depositors in a balance sheet. That secures the 103. And secondly, the upside would be bought from a bank that's at least rated S&P A or better, and that would be by virtue of exposure on a call options to the upside in the market. So the risks are to the suppliers. Secondly, the risks are that the stock exchange crashes, in which case the investor will just get the 103 back. So the minimum investment amount is equivalent to $18,000, and subscribers can put that amount or any amount higher than that into the shares. So the fees are sold through distributors, and these distributors have the right to charge at an agreed rate between them and their client 0 to 2% upfront, and those fees would not form part of the capital if charged. Inside the company there are fees provided, and they are spelt out in detail in the prospectus and in the marketing material, but they don't affect the investor's return. So the 3 minimum and the 34 maximum is a function of the fees already being taken into account. So the offering will open with immediate effect and will close by the end of June. And investors should be mindful that FICA is required of the investor. So if there's interest to buy the shares, they should do that portion early with the distributor so as to have it done in time for the close. So there's a full prospectus and marketing material on the Investec website and application forms. The shares are sold through accredited distributors who have to have the correct licenses with the FSB, and we could provide names if investors sought such names. Otherwise, their own advisor would probably be able to support that. It goes with an application form and sending of the requisite cash to Investec Bank Guernsey, linked to the subscription app.